Hey fellow traders, Philip Tigerson here from Stock Market Strategy. I want to apologize for not making new educational videos, but the truth is we've been really busy setting up an offer with TradeStation where we can now offer our core strategy seminar for free if you sign up with TradeStation. If you're interested in that, you can read more about it on our website. But in this video I want to talk about stop losses, both the initial stops and trailing stops. My first advice is always use stops. A lot of new traders who start trading don't use stops. They don't really think about it. And when you don't use stops, you can end up losing a lot of money because you simply just see how the stock goes against you or the future goes against you, and your loss is getting bigger and bigger, and you're kind of a deer in the headlight that you just stunned and you don't know what to do. So if you have a stop in, it will take care of it. You know what you're risking when you enter a trade. My second advice is that you never move your stop in the opposite direction of the target. That means if you're going long, you're only allowed to move your stop up and not down. By moving it down, you're literally opening yourself up for unlimited losses because you can, in theory, keep moving it down. So only move it in the direction of the target, which makes it a trailing stop. Now there is 7 different types of stops. The first is the volatility stop, which is using mainly an average true range. Then we got the last pivot, which is the swing high, swing lows. We got the X bar highs, lows. We got the pointed percent, moving average, reverse of entry signal, and the last trend line. But let me explain these and show you on charts how they work one by one. The first is the volatility stop. It's a stop that is based on historical volatility. So if the stock is very volatile, the stop will be bigger. As mentioned, it often uses average true range in its calculation, meaning it calculates what the stock normally moves, and if then moves more than what it normally moves, you'll get stopped out. So it's a stop that makes sense. If a stock normally moves only 3% a day and it suddenly moves 6%, you should be warned about that and potentially get stopped out because something different in this stock is going on. So it adapts to the stock's current movement, and let me show you what I mean by that. Here you see a volatility stop, and you can see my 2 white arrows here, and you can see how the volatility stops drops a lot just because the market or the stock drops. So it adapts to the stock immediately. Yes, a volatility stop does use historical, like a 14 period setting, but you can change that to, for example, 7 only. But it adapts a lot faster than a moving average. Here you can see that the stock suddenly drops a bit faster than previous after consolidating for 2-3 bars. Because of that, the volatility stop also drops and then tries to catch up. So you are using a more flexible stop that kind of looks into the stock's up and down movement and tries to keep you in the stock, or future for that matter, as long as possible. And then simply a close above this volatility stop would then stop you out over here. So try to look into this volatility stop and change the settings. It also depends on whether you're a very aggressive trader or not and which market you trade. Last pivot high low is the second type of stops. It uses the last swing low in an uptrend or this last swing high in a downtrend to see where the buyers or sellers should come in at the latest. And normally if those pivots are taken out, that the trend changes. So it's a very smart place to place your stop. Why? Well, if you're long in an uptrend and you take last swing pivot out, then you expect the trend to have changed. And if the trend has changed, why be long then? If the trend has changed into a downtrend, you don't want to be long anymore. So it's a very natural and smart place to place a stop. And let me just show you how it works. In this case, there is some sort of a consolidation pattern here, broadening pattern. But when it then takes out the swing low over here, your entry is triggered. Your stop is then above here because that's this last swing high. Then if you were to trail this, you would then put your trailing stop here when this low is taken out. So when it takes out this low, the last swing high is now this. So that's how you would use the last swing high in a downtrend to place your stops and also place your trailing stop. The next stop is when we make a new X bar high or low, meaning that price takes out X amount of bars to the left. For example, when price makes new high over the last 20 bars, that could be your exit if you were short. Or if price makes a new 20 bar low, that could be your stop when you're long. Let me show you how this works on the chart. For example here, if you took this flag pattern to the downside, your stop will be when price makes a new 20 bar high. And that happens when the cyan color comes on here. Why? Because this bar has now taken out the high of one of the last 20 bars. And the highest bar in the last 20 bars is this one here. So when this bar breaks out of that, it colors it cyan. That could be the stop. Now there's a way to use this also for trailing in a more advanced way, and that is you can see how we get these pink colors dots all the way down. It shows that price makes new 20 bar low, and when that happens it shows the momentum is still strong. When we see price come down and test this pink dot but not prints a new pink dot, it shows that price is not taking out the prior low, and that shows the momentum is drying up. You could decide to book profit, either half or all, when you don't see that follow through to the downside, and it could turn into a double bottom. So as long as you see these dots, it shows the momentum is still strong to the downside, and you should definitely try to trade it for maximum profit. The next stop is the point in percent. It is often used when you're trading only one market or instrument, and that's for example the NQ. It wouldn't make sense if I use a $1 stop in Apple, which is a $600-700 stock, and for example a $1 stop in a $5 stock. $1 in the $5 is 20%, and $1 in the Apple stock is less than 1%. So using a fixed point stop is not really that smart unless you change that point stop. But how do you know which one to use? So that's why it's often used when you only trade one market, because you then have an idea of how much this stock normally move, and you then have a good number to use, like a 10-point stop in NQ or 5-point, depending on what time frame you of course use. It's used relative more in day trading or slash scalping, where you go, I want to quick grab 2 points in the NQ and I got a 1-point stop. I'm not letting it go more against me. And then you just use a point stop because they need to go in and out quickly and can't really wait for indicator or volatility stop or moving average, something like that, to update to the price. The next one is the moving average, and it's very common used as stop, where a close above or below the moving average will then trigger the stop. But there's a little bit more advanced ways as well to use it, and it's if you adapt and use the moving average for reference. But let me first show you how to use it as a normal stop. Let's say you took this bear flag here and you went short. Your stop is then triggered when the price closes above the moving average. But there's a way you can use the moving average as a bit more adaptive, and that is if you measure the difference between price and the moving average, and if you see then that it narrows, that the momentum is drying up, and you should probably trigger your trailing stop. And you can see, for example, here that price comes close to the moving average. It's narrowing the range between the price and moving average, and that could be your warning sign to get out. For example, when this bar doesn't have really followed through and we gap up the next day, you say, let me get out, the momentum is drying up. But otherwise a normal stop will simply be a close above the MA. So if you took this one here short, your stop is above this MA all the way down. Both your initial stop and your trailing stop is the same. Another stop is the reverse of the entry signal. For example, if you have a stochastic crossover to the downside, your exit will then be if the stochastic cross to the upside. This is best used if you combine it with a normal hard stop. Let me show you here a way of using the reverse signal. We got a MACD here, and we can see we got a crossover to the downside, and you go short here, and your stop will then be when MACD crosses to the upside. That's a very simple stop, but in this case I recommend using a hard stop above the price, for example, or using the MA, because if this one crosses to the downside and you get your entry signal, what if the next bar blasts up to the upside and it takes a while for the MACD to adapt to that because MACD is lacking? So I always recommend using a hard stop when using indicators for stops. Here's another signal, and in case you have taken this one, depending on your rules, you would have been entering here on the crossover, and you would then have been stopped out over here. Then you would of course re-entered and stopped out down here. So if this is your way of trading, you would have been in and out a couple of times, but you still have made profit. Another way you can use stops is a trend line. The trend line is a bit more tight, that more aggressive than, for example, a moving average, because you can choose how to draw your trend line more aggressively. You can also redraw your trend line for an even more aggressive trailing stop than your initial stop. Let me show you how this works. Here you can see a trend line drawn in. Let's, for example, say you took this bear flag to the downside. You've drawn in a trend line for this swing pivot high to this swing pivot high, and then extend that trend line all the way down. Your stop will then be when it closes above the trend line. And then if you want to be more aggressive, you can redraw your trend line like this. In this case, you would have gone out the same time, but a lot of traders like to redraw the trend line, so they're really aggressive. You're only interested in the strongest of the strongest trend, so that's why you redraw a more steep trend line as your trailing stop. The first one is not so steep. You need to give the trade a little bit room to start working out. But when the stock then starts dropping and the trade works out like this, you want to tighten up to make sure you book a decent profit. This ends this video about stop losses. If you're interested in a free trading course, then visit our website www.stock-market-strategy.com. Have a good day.